Welcome to the Twomey Stock Market Report. I'm James Twomey, and today's Tuesday, November 22nd, 2022. Well, happy Thanksgiving to all my subscribers and to the YouTube video watchers. This has just been one heck of a market. We've got a lot to cover in this week's video. So what we're going to do is we're going to break it down. We're going to give you some ideas, but also to point where the market direction is headed. So let's go. We're going to get right into this. The insight on the market fundamentals, we'll cover that briefly. We'll go over a little bit of the technicals as well. If you saw my latest stock market newsletter that came out over the weekend, delved quite a bit into fundamentals and technicals in one particular sector. And it's a great example of how we do not want to be a reactive trader. Reactive traders, there's nothing wrong with them and they make a lot of money, but you're much better off finding a longer term trend and taking advantage of that advance. As we've said before, we don't buy at the bottom and we don't sell at the top, but when we identify that inflection point, we go all in and heavy. If it works, it takes off. Great. We put in protective stops along the way and then may add to it. If it does fail, we get out and we get out quickly. That's the way it works for us. It's very hard to time the market. And the last couple of weeks has been a perfect example of that. So, okay, I want to go into a couple of things today. Stock sector, advanced decline. It's going to give us some insight, a bigger picture, right? We're going to talk a little bit about sectors, and I'm going to give you a couple of examples of where we are, of the market's either ready for a decline or a breakout. I don't know. I'm not in the prediction business. We follow the tips, the Twomey investment process and principles, and we apply those to our trades. And I will not at this point, but we do have a mutual fund that we're considering. We've alerted subscribers this week to a couple of trades. I held off on 2 to 3 trades that are doing very well, but we'll go over that, not that particular necessary trade, but that why we're holding off. So we're going to cover all those here today. And of course, you can find all this at TwomeyStocks.com. That's the number 2, MEstocks.com. Every week we send the subscribers over 20 plus pages of detailed technical, fundamental market analysis. So we don't just trade either fundamentally or technical. We marry the two. We also provide, and it gives you a much more intensive view of the market and how to approach your trades. Okay, market volatility, large swings. Yeah, it's starting to, hit that that time of year where volatility is going to surface. And I'm just going to say this now. As we get towards the end of the year, there's a lot of tax loss trading. What do I mean by that? People who have lost money in certain areas can sell that stock or fund, harvest that loss tax-wise, even in some cases carry it over to future years. And in some cases, if the person or people or fund is really still interested in that stock, they'll buy it back after they sell it, which is really interesting because now their cost basis is much lower. They've harvested the target, the tax loss, and when they move forward, and if the market takes off, they got a much better swing upward, and it makes their portfolio look good. Not a bad trick, but that causes churn in the marketplace. Also, too, coupled with that is as we reach the holiday season, less trading. It's analogous to the summer. If you've listened to my videos and market reports, we've said it ad nauseum. When less volume is being traded, the market is less institutionalized, if you will. You could get some swings, good or bad, and often the market will go up during holiday trading because of that low amounts of fund management trading. Okay, so what's going on? We've said this before. We're talking about demonstrating power in the market. We're seeing it in the Dow Jones Industrial Averages. A lot of reasons for that. We're not seeing that area of companies yet being hit with layoffs. Their costs are definitely going up because the cost of energy, cost of hiring people, benefits, etc. But they're able to pass that along somehow, and that's working out. The other thing is the infrastructure trade stimulus bill. The chips bill will be coming on. This green bill slash inflation. They're adding trillions into the economy. They're heading towards a lot of union type jobs. Not good or bad, doesn't matter. I'm just saying that it's keeping that sector of industrials moving, and as well as the price of commodities go up, or materials because of inflation, they can show better um, areas of profit at times. Okay. So, what else is happening? Financial and banks are doing well with the increase in interest rates. No surprise there, but it's a good thing to see that they're not being hit like the financial crises, these lending institutions, not yet anyways, at least on the real estate market. The real estate market has been able to serve because that most of the, even though people overpaid for their homes the last couple of years, they were in low cost fixed, whereas the last financial crisis, many more were in variable rates, and as they went up, it really crushed people, and then they lost their jobs, and it was a cascading effect. Uh, I read this article. I'm going to get the country wrong. It was either Sweden or Norway, but it was the Netherlands area, and they are heavy into variable rate mortgages, and they're finding stress on the real estate market. Markets are not only coming down, which is coming down everywhere, but they're also now struggling with the fact that people, if they got to liquidate or they got to get out of that, they can't refinance because the rates are up, and they can't get out because the prices go down, and that becomes a real problem. You isolated in that area because of, again, variable rate mortgages. The energy sector, up and down. We've heard all kinds of stories here. I bring it up in my newsletter. I had a great newsletter this week focusing on energy sector. Gave you a couple of different things technically and fundamentally to consider. Material sector, you kind of separate this between like gold, silver, copper, those type of hard materials, and then chemicals and alike, the more industrial materials. Okay, so there's two kind of areas there that we look at. And REITs, real estate investment. Don't tell me why. Bounced up off the bottom. It's struggling a little bit here, but they're still up. So we're in that as well. So these are the areas that do well. High tech sector. Google just announced another 10,000 layoffs. 10,000 layoffs. Amazon's going to lay off 10,000. These are, couple to 3% of their working force. We're seeing it across the board. Twitter, of course, on that buyout going from, publicly traded to a private company. No surprise there. That's all about trying to get in line and make some money out of that thing. Carvana, the online, a whole host of others. They're in my newsletter about Redfin, the online real estate. Everybody's laying off in the high tech sector. Why? They have to overpay to keep their employees. Alphabet or Google, whatever you want to call it, they overpay for their engineers so they don't leave to go to startups or other companies, and they're also overhire. They tend to overhire, so they're getting that bubble. As revenue goes down and the gig economy changes, people are not, there's not a lot of small money going into Google ads, all that kind of stuff, you name it, but their revenue is coming down. The high tech sector is going to be hit first and most in this economy for whatever reason. Not really sure yet, but we're doing some research on that. But it looks like they're not benefiting from these infrastructure and chips bills at this stage, and they're getting hit with the higher cost to do business. Pure and simple. Okay. All right. Let's kind of get into this. The advanced decline. I like to bring this up every once in a while. You know, some people even trade advanced decline on a daily basis. I don't recommend that. I don't feel it's that good. I like to look at it more from a bigger picture. This goes back into July, beginning of August time frame. If you look at a year advanced decline chart, it's even more telling. But this is basically advanced decline. It daily advances and declines in the market gets graphed, if you will. And then here you can see, I'm just going to go over a couple of things. This blue line is the 50 EMA, the red is the 200. Every time everything, especially when the 50 crosses below the 200s, the death you cross, and all negative for the market, usually the market. And of course, the market's been down all year to date. So as you can tell, anytime we had any advances that got up around this either 200 or 50 EMA, the market would pull back. We had a little bit in that bull market rally in the summer, how it got up from across the 50 up to the 200, very promising, and then implosion, right? And then all the way back down to the bottom again. We bounced around the bottom for a few weeks. We've now pulled up off that. We crossed up over the 50. What I like about this is it's a little bit slower right now, and it's also, we've got a stabilization in the relative strength index. The MACD is crossed over positive. From a longer term trend, I'd like to see this stabilize and flatten out. And we also look at how many stocks are trading below their 200 EMA in the New York Stock Exchange. It was down to 81 or 82% at the and the last financial crisis was 100%. We're now around 50 some odd percent. So 54, I think, are below. Way up off the mat, if you will, and it's showing some staying power. Will it pull back just like we did in the bear market rally? I'm not quite sure, but I like this slow advance sideways, and I like the fact that we're starting to use the 50, the blue 50 EMA as potential support, because it did break down once and then has cascaded above since. And as it tried to reach it a couple of times here in end of October, early November, it got repelled by it. So we're going to see how that goes. Will it be a bear market rally? This is what I want you to walk away with. See how when it crossed over the 50 over here at mid-July, the bear market rally, and we went all the way into mid-August, 30 days or so, where then it finally got repelled at the 200, and then it couldn't, once it broke it and broke below it, it never, was able to eclipse it again. We're, just getting over that 50, if we mirror that and we can try to get up to that 200 EMA, what I'm trying to say is we could have another 30 days of advancing to happen. Again, I'm not in the prediction business. I just want to give you a snapshot of, overall trend. Healthy, if you ask me. All right, so let's see what we wanted to talk about, some of the staying power. All right, here, I'm going to go to our charts here. I'm going to come up with this stock here. It's an ETF, industrial sector. And let's see if I can pull this up real quick. Industrial sector. Okay, in there is the top 10 holdings. Raytheon, Honeywell, Union Pacific, United Parcel, Caterpillar, all doing well. And what we did look at this year, and we said, hey, and we missed out on a couple of things on that sector. And it's raced up and beyond the last, couple of months since October's bottom. And every time I look at it, I want to recommend it, but we got over the 50, we got over the 200. This is what I'm going to expand this a little bit here. We are right up at the last bear market high, coming right up to it. And, chartists will tell you, this could be a V-shaped recovery. It's a kind of over too longer period of time, if you ask me. But, and then they'll also say if it's a cup and ladle and all that. I don't follow that. I find it, helpful in rear view picture, not forward picture. But what I will say, we're getting up to the bear market rally highs, and we're seeing it flatten out, right? So we've got almost 10 days of it being fairly flat. Are we going to use this as a springboard and continue and break up and get back to the year-to-date highs, right? We're not that far away. We're not that far away. So it is, if we're going to, let's do Fibonacci retrace from that year-to-date. Let's see if I can pull this down a little bit more. We are heading up to the 0.74. A 0.68 retracement is usually pretty strong. Once that shows resilience and as increases the odds, you're going to get that 1-to-1. Well, that's the bigger picture. I don't know if that's going to happen. I'm going to take this away because it gets messy here in the chart. But we're going to watch this. If it does break out from here, we got a chance to go from 100 up to, back up into the 108, 109 range. But now we want to look at a couple of things, and I'll go over it real quick. 50 EMA, way down here. That's a long ways away for support. You got the 200 above that, very positive, 200, right? And why do I say that? Because the 50 is getting ready to cross the 200, and that's the death. That's the opposite of death cross, golden cross, I guess, right? That will bring a lot of traders in. And we've got we've got our 9, our 14, and our 20 EMAs all acting as support. So everybody's in there. We've got, if it starts to pull back, technical traders are going to look at this and they're going to say, hey, wait a minute, it may bounce off these various support ranges, right? If we look at the MACD here, and that's what this is why I did, last week we probably should have gotten into this, but the reason why I didn't alert, and I was contemplating into last week and this week, the MACD is starting to flatten out. Even though it's very positive, very high, it's flattening out. The stochastic's been flat for a while. This is a real good sign because the stochastics we've mentioned in our newsletters. It is our slower oscillator. It is our fast oscillator. It's going to indicate change, direction. Once we start seeing things into the 75 to 50 range, we know the market is probably going to decline. This has been it took all of October. Look at this, September to October. It was way down here, and then beginning of October, it took all of October to get into some above 75, right? And it's hanging in there, just like back here in end of the bear market rally of the summer. It hung at the bottom, right? So we're watching that. That's still positive. The MACD is starting to flatten out again. It took all of October to get into the positive. So it takes a lot of energy for stocks to move this far. This is, will it drag the market up? Will it drag the NASDAQ and the small caps and the SPY up? Hard to say, but this is what I want to tell you. The very positive notes here, and that is the industrial sector. We went over what's in that. Talked a little bit about how materials, and I'm using these sectors because it's a lot easier than going over individual stocks, right? This is the materials. Now, remember we talked about how materials could be mixed. Sometimes it's gold, silver, and copper. People talk about materials, and that's a lot of dollar dependent. And this is, think about it, this is Lin, these bottled gas, that type of thing, gas production. For use in production, air products, chemicals, paint company, Freeport-McMoRan, Nucor, Newmont Mining, Dow Chemical, all these, that's the top 10%. Some, pretty good companies. But look at it, B, C, 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 B, B. Nobody's really looking at these as being, hey, someplace, it's got to be in this market. All right, a little bit different picture. We've got a lot longer way to go up to the year-to-date highs, which we hit twice, but 91, and it's at 81 now. So it's above the 50, it's above the 20, the 9, the 14. The 200 is quite a bit away from here. So this has got some breadth to move. The stochastics are up. The MACD is positive, and the stochastics remain up, elevated above 75, green above the red. MACD is up and in the positive territory as well, flattening out a little bit. This is being dragged up as well. Good sector. So we got to keep in mind that from a technical point of view, things are looking strong and positive. Is it flattening out, and will it retreat? And the concern is, was it like the summer rally, and then we get the retreat from the summer rally here, and then that was a very big downdraft, right? So we got to watch this whole area if it's going to flatten out or break out. If it does break out, we've got, and we're going to use the last high Fibonacci. We've got the potential of, let's see, I think it's probably about 0.5. Is it? No, it's 0.618. So if we get above that 618, like the industrial sector, there's a high probability going 1-to-1. So we'll take a 10-point advance any day, right? But we don't know if they're. I want to look at the weekly chart for this just to give you an idea. We just got the buy signal on the weekly chart. That is very, very promising. All right. So fundamentally, we've got a lot of stimulus dollars coming in, propping up the market. Yes, interest rates are rising. Yes, it's crippling the economy. Yes, it's slowing down the economy. It's hitting the places that aren't receiving the stimulus dollars, high tech, right? And maybe in the CHIPS bill, we'll see that on the manufacturing sector. But that's another segment for another day. So let's take a look at that. We use XLK versus the NASDAQ. It's a technical sector, another ETF, and another busy chart. But here, let's just take a big technical pick. The 200 EMA is way up here. 50, we just crossed above it. The 9 and 14 and the 20 were above. The prices were above that. Stochastics are just starting to flatten out. They did, come up off the bottom, but then we had a drop back in early November and up. Very volatile. MACD is in positive territory and still flattening out a little bit. Very promising, though. Very promising. We're getting a little bit of flattening out here. If the industrials sector can drag this up, this would be very promising because we've got quite a bit to advance here. Quite a bit to advance. Just from the bear market rallies, we're not even at 50%. We did get up to 0.61 and come back. That's just from the bear market highs. We're quite a ways off from up here in the early 2022. So this is promising, but it's definitely lagging. So we've got to get this to move a little bit. Let's see. I want to look at REITs. This is an interest that, I'm just going to be blunt with you. I mean, here fundamentally, are people going back to work? Are rents still, possible? Are people expanding? People are moving out of these high-cost tax cities to go to lower-cost areas. Industrial REITs seem to be doing good. Big retail, not just rental, properties for. But mostly for bigger companies, right? So that's promising. That's promising. Again, the market is showing breadth. That's what I'm saying. We're seeing a variety of sectors take off. Will it continue? Again, who knows? But from a technical perspective, we just crossed above the 50, and it's hanging up above that 50 for now, 7 days, 10 days. The 200 is quite a ways off. There's a lot of work to be done, but we're moving in a positive direction. Again, stochastics up over 75. We'd like to see it higher. I think today actually it's 80. So we'd like to see it higher and there, but it's been there all of November, and it took quite a bit to get to that positive territory. Stochastics are again, I'm going to repeat, faster oscillator. We use that as a quick indicator. If it starts dropping down below 75, I pay attention. I'm on the alert for a change. I don't trade it. If we traded this crossover here, you'd be in and out of the market every other day. The MACD, a lot of people use this. When the green crosses the red, they jump in, vice versa. We made that crossover, but it was in negative territory. Now it's in positive territory. The green is still above the red. That tells us longer term trend has been developing, and sure enough, the prices had developed. We got a buy signal quite a bit ago. We did jump into the REITs on a pullback. We'll see where this goes. We'll see where this goes. Fundamentally, I'm still trying to figure it out. I'm doing some more research on it, and we'll continue that in our weekly newsletters, right? So that gives us a couple of areas that I want to stress. I believe at this juncture, we're going to look at a market that has some staying power, but I need to see that. Some of these industrial trades, we took advantage of it in the energy sector for sure, but looking back now, some of the trades that we didn't take could it's hard to jump in right now because they are topping. But I've been saying that for a couple of weeks now, right? So sometimes you just have to follow the fundamentals, and the technicals are now bearing that out. I want to go over one more thing. Let's try XLE, because energy, everybody was saying, hey, energy market's over, prices are coming down, get out. We've exhausted that. And they're probably, it could be true. I mean, fundamentally, we looked at in our newsletter this week, we went over a couple of stocks that we own. We looked at that sector. Fundamentally, the debt to equity ratio is low. Their return on investments is strong. Their P/E is in the 9s and 10s. S&P's in the 20s. I know it's a different sector, but they're healthy. And the reason why I bring that up is they're healthy because there's so many headwinds against fossil fuels and materials and chemicals. And they're all doing really well. Anyways, we talked about this is XLE, the energy sector. Let's see if we can pull that up. What's in there? ExxonMobil, Chevron. We own some of these. Schlumberger, ConocoPhillips. Schlumberger had a great run up this year. Marathon Oil, Occidental, Devon. Devon's got a huge dividend, by the way. So, conglomerates that do well in that space, right? Where are we here? Okay, so we talked about this for a while. The cone. We do the Twomey. Oh boy, Twomey. Sorry about that. The Twomey trend track line, right? The market doesn't know about this trend line, but and it's kind of a rear view mirror. But we do watch it because when it breaks through it, it tells us something's going to happen, right? I mean, no rocket scientist there. And we use it to look at the overall trend. It's a verification of our, so we don't get a bias over our, fundamentals of technical analysis. With that said, here's what's going on. We said, hey, that cone, as that cone forms, that means the price point's narrowing and something's going to have to change to get this more in a parallel. Now, if we bring up, and sure enough, the blue line is much more depicting a parallel line. Doesn't have really 3 touch points. It sort of does here at the bottom and up here at the top, but you want 3 solid major touch points in your track line. But in order for this blue line to come down from the red, prices have to decline, and they did. Now, one of the things we looked at, I'm going to go over a lot of stuff here. We looked at well above the 200, well above the 50, above the 14, 20, and 9 EMAs. Stochastics, been for quite some time, even during the bear market rally when we got out of some of these, the summer rally, we did get out some of our energy stocks and as they took a breather. But, you can see the stochastics, the first indication of trouble has been coming down. And it has, the red is, was, and green have been changing inflection points. And it is declining, and I believe it's in the 50s. It's 66 today. It had been in the 50s, so 41 actually, parts of last week. So that's telling us pressure on the price is coming down. The MACD, flattening out, and we're like, that's what if we go back to our material sectors, the flattening of the MACD gets me a little nervous sometimes. It's not a big inflection point. It could stay flat for a long time. We talked about our relative strength index. We haven't mentioned that yet today. The relative strength index here, was up in the 65, 64 range. Now it abated back last week to the 54. The question is, will energy bounce here and continuous rise or go sideways, or are we going to see a further decline? A lot of the pundits, especially technical chartists, are saying decline is on the horizon. Yeah, we did tighten some of our stops. I believe one of our third in XLE got stopped out this week, actually. And, so we alert subscribers real time via email. So they stay abreast because I know not everybody's watching the market. That's fine. We help you out. Let's see, 0.382 retracement from the last high to the lows. This recent low, to the recent high is, puts us somewhere below the 50. So let's say the 50 becomes a repellent. It could come down to 85. Sure, could come down to 85. We got our buy signal back here and, down in the 70s. So, we did protect some of our profits. We're going to watch this because we're going to see if it's going to actually take off or it's going to go sideways. We've got a lot to consider here. Energy as a whole, it's a difficult trade. It's very volatile. You can wake up 10% down. It's based on futures. You've heard me say this 1,000 times. It's based on a myriad of things. It's a commodity. It's hard to trade even fundamentally. You look at stockpiles. You look at availability. You look at refining. You look at demand. It is all kinds of equations that mathematically you can look at, and it can tell you three different things when you finish that analysis. So experts really watch this. They know how to trade it. We've been very fortunate to make some good gains off of energy this year, and we got out really quick following our principles. And actually, we just alerted subscribers to a new trade. And we're also going to look at one more thing. We're looking at TLT is the 20-year. We did sell off our TBT. Let's look at TBT first. That was our 200%, or TBF is the 1-to-1. And, we got the sell signal on that. We've been in that at quite a time. We've got a 44%, a 38%, and a 36% increase on that. That's the second time this year we've run those kind of numbers on this trade. So, subscribers, pat yourself on the back. That's a great win. But we got our sell signal. It has dropped from our sell signal from 35 down to 32. So almost not quite 10% there, but a little over 10%. So we're out. We've been out. And, it's starting to flatten out. The here we are, stochastics, low, MACD's negative. Again, everything right now is pointing to leveling off to going down. So what does that mean? That means yields are abating. Yields go higher as interest rates go higher because bonds have to provide a higher rate of return, meaning their yield has to be higher to attract investors. When the opposite happens, then yields come down. All right, so we know the Fed's going to raise rates at least 0.5 in December. We know the Fed they marched out all last week because we've heard nothing for 2 weeks before that. It was the Fed's going to pivot. We've gone too far, too fast. Every day it was the Fed's gone too far, too fast. The market needs to recover because we've put too much pressure on these companies, layoffs or whatever. Folks, inflation is still over 7%. It is not going away. It is not. We're not going to wake up January 1st after December's rate increase and inflation is going to be down under 4%. We've got to get that from a perspective. We've got to eliminate that thought process. If it is, that means something catastrophic has happened to the economy. I'm not quite sure that's going to happen with all this government stimulus spending out there. The high-tech sector, they're in trouble, but the retail, financial industry from the real estate market and housing, they're in trouble. The lending for housing, they're in trouble. But are they in trouble because of lack of buying and selling? Yes. Are they in trouble because of underperforming loans? Right now, we're not seeing it. We're seeing it in the car sector, though, but we've been hearing that for a long time. Anyways, I diverse. So we see how this is flattening out. We did make a trade into short-term and long-term bonds. We do expect a little bit of a bounce. I always look for areas on trend inflection changes because sometimes things are a short-term change, sometimes they're a sideways change. The probability of racing off, especially in the bond market, or racing down is rare. Okay, so I look for places to park our money. Typically, we'll be in a mutual fund, and we'll say, "Hey, take this chunk of your money, put it in this mutual fund. We got a good chance the next 3 to 9 months, it's going to be a positive return." And whatever that may be, but it's a good place to park our money. Whenever you can park your money and not actively trade it, even you may not get the big rise, but as long as you get a good rise and you sleep well, I like that, right? And we do have that. We're getting close to making a recommendation in mutual fund as is. But anyways, some of these so TLT is the opposite of TBT, 20-year. That means the yields are going to come down. We're still in rising interest rates, so our yields are going to come down to drastically. Probably not. This is most likely just a bounce. There are a couple of things technically here, but let's just look at it slowly. The stochastics have bounced up off. Look how long the stochastics were negative and low here. They've bounced up. MACD is just starting to cross over positive. That's telling us the trend is forward, right? Positive. Prices have advanced. There's been some fluctuation, but it's above the 9, the 14 to 20 EMA. It's starting to get near that 50, and this is what I liked about it. This is why we recommend it. I got into it a while back, back here. I recommended it just recently to the subscribers, but that's because the 50 is acting as repellent or support. That's a great sign. I know we're going up in rates. I don't know. The first of the year, I don't think the Fed is going to change their stance the first 3 months of the year. I really don't. And I do see maybe 0.25 increases versus 0.5. We're probably done with the 0.75s. I believe that, again, I'm not in a prediction business, so just, this is under the caveat of we need to understand and watch, right? It's looking more and more like the lagging indicator is going to be unemployment is going to rise, but the market may start to rise sooner. Two things driving that: if we don't go up high, that much drastically higher in interest rates, and the midterm elections start to kick in. You've seen a couple of my videos or whatever. We talked about how midterm elections. So there's a lot that we're going over here. I don't want to overthink it just yet. It is a holiday shortened week. We're getting near the year, and these are places we may park our money. We're also got a quick trigger. We're not going to hang around if the bear market returns. We are in a bear market, but if it returns, we're not going to hang around. We've got a couple of plays that are handling that tech sector, which we are on watch because that is struggling very, dramatically. And what's also concerning is the small caps. We're kind of doing very well. They're now struggling. So the Dow Jones and the industrials and those areas I told sectors, they're dragging up the S&P, which is good, but the S&P is really struggling to show real positive advance. The small caps started to revert, which is interesting. I don't like to see that, but and then the Nasdaq has not caught fire yet. So we're not out of the woods yet. We're looking at this as a year-end bounce, and we're trying to play it as such. So there you go. We wanted to kind of go over a few things. It's a little bit lengthier than I expected, but go to TwoMeStocks.com. That's the number 2, MEStocks.com. Sign up for our alerts. Get our newsletter. It's a quick, way to keep abreast of the market. We go over all types of, areas that most people don't have the time to look at. And you know what? It's great information to have if you are even if you're thinking about getting into the market, you haven't traded it, there's a lot of systems out there. We try to simplify it for you. We really do. We want to give you the buy signals and sell signals, the stops. We give you the trade tracker so you can each week monitor it. We send out the alerts via email real time. You can't miss out on a trade. And you don't have to overthink it, right? Because what do? We are always climbing that wall of worry. And that wall of worry will make us a reactive trader. And if you're a reactive trader, I can guarantee you, you're going to lose money. So that's it from the Twomey Stock Market Report. I'm James Twomey. Happy Thanksgiving. And if we can, we'll update you over the weekend.